evening, ladies and gentlemen, and welcome to tonight's webinar, where with the help of our iFAST research team, we will share with you more about the FSMOne ETF RSP. One of our most popular features actually on FSM, the ETF RSP is actually a very useful tool which you can use to begin building your investment portfolios. To tell you more about this investment strategy behind regular savings plan, as well as the best-in-class ETFs that we have on the FSM platform, please help me welcome tonight Charmaine Tan, as well as 𝗪𝘃𝘃, who will be our presenters. Let me hand over the time to Charmaine.
Hi, thank you. Let me just share screen. Okay, so hi, good evening. It is nice having you all here today. I'm Charmaine, and today I'll be sharing how you can employ dollar cost averaging with a regular savings plan, in short, RSP. So first, what is a RSP? So RSP is essentially a monthly subscription plan that allows you to put in a fixed sum of money into a particular investment product. So once you apply for it, everything is automatic. All you have to do is to ensure your FSMOne account has sufficient funds, and it will automatically be invested into your selected investment products. So why do people use RSP? So RSP can actually instill financial discipline, since it ensures that you are consistently putting your money to work each month. And what kind of products can investors invest in using RSP, you may ask? So there are actually a wide range of investment products that are available under RSP. This includes a selection of ETFs on our platform. Moving on, so just to share, RSP actually adopts the concept of dollar cost averaging. So if you're unfamiliar about this, don't worry, I will go through that with you. So dollar cost averaging actually means that you are investing a fixed amount of money into a particular investment regardless of the unit price and at regular intervals. So this also implies that you will buy more units when the price is low and less units when the price is high. So in this simple example shown on the screen, without taking fees into consideration, an investor chooses to set aside, let's say, $100 each month in a particular investment product. So in the month of January, the price of the product is $10, which also means that the investor is able to get 10 units of the product with his investment contribution of $100. And in the next month, which is February, the price goes up to maybe $10.50 per unit. But because the contribution is still the same at $100, the amount of units bought is lower than that of the previous month. So the investor will only get about 9.52 units. Whereas in the month of March, when the unit price falls to 980, the number of units bought goes up, and the investor actually gets 10.2 units. The same concept will apply for April and May. So at the end of the period, with a total contribution of like $500, the investor has bought a total of 50.73 units at average price of $9.86. And this is how dollar cost averaging works. So if the investor chooses to throw all $500 in January, he will obtain only 50 units at an average entry price of $10. Hence, it may be more prudent to adopt RSP, as you would be able to obtain more than 50 units and at a lower entry price of $9.86. Now that we have gone through the basics and mechanisms of RSP, let's move on to the benefits of using RSP. So I'll be sharing two different benefits. The first benefit is that RSP allows you to get started with investing with even with limited capital. This is especially beneficial to young investors such as students or fresh grads, or investors who are new to investing and wish to start out small. So if you are of such profile, RSP will be great for you because all you need is as little as $50 each month to get started. Starting earlier is important, as it means that there is more time for your investment to benefit from the effects of compounding returns. So to help you to visualize how much capital you can accumulate over time using RSP, we have this table over here. So let's assume that an investor is doing a monthly RSP of $100 excluding fees. If the rate of return is 3%, which means that every year you are getting 3% in returns on your investment over a span of, let's say, 20 years. This particular investor can accumulate $31,992. And a rate of return of 3 to 4% is achievable if the investor invests mainly in bonds. But if the investor is able to get a rate of return of 10% by investing in riskier assets such as stocks, they can accumulate $75,900 at the end of 20 years. You may have also realized that the holding period is important, as 20 years in the market versus 10 years, the market can make a lot of difference. You can accumulate close to 80,000 in 20 years, but if you are only invested in the market for 10 years, you are not even getting like half the amount of capital. So the holding period is something to take note of. Now, using another example, using a higher monthly RSP of $500 excluding fees, you can also roughly see the compounding effect over the years. Assuming a 10% rate of return, an investor can accumulate a sum close to 380,000 at the end of 20 years just by investing $500 each month. So the longer you are invested, the greater the effect of compounding. If not having enough capital is keeping you away from investing, we encourage you to consider RSP as a way to start your investment journey because you don't need a huge initial sum of money upfront. So moving on to the second benefit is that RSP actually promotes a disciplined approach to investing because RSP enables you to put in a fixed amount of money on a monthly basis, regardless of the price. It helps investors to avoid emotional investing, especially during a market downturn. So in the investment world, we often hear this saying, buy low and sell high. But in reality, buying low and selling high is not an easy task at all, especially if investors let their emotions control their investment decision. In today's market volatility, some investors tend to be fearful of the market because they think that the market will fall further. Such investors may try to time the market and catch the bottom, but instead, they might just miss on the buying opportunity completely. So to avoid such situation, consider RSP as it can help you to stay invested and stay disciplined. As RSP is automatic, it ensures that you are investing regardless of the market condition. You can eliminate any form of guessing game and no longer have to worry about missing on investment opportunities. In other words, RSP actually help you to avoid the pitfall of market timing. So here are some examples to help you visualize how RSP can really shine even during market downturns. So if you look at the table over here, we have made a comparison between an investor who only makes a lump sum investment at the start of a crisis because they were fearful of the markets versus an investor who did RSP from the start of a crisis all the way to the end of the crisis. And here's what we found out based on the examples of past crises. So an investor who did RSP would actually perform better than an investor who did lump sum investing at the start of the crisis. So the maximum drawdown of their investment is lower, and also the amount of time it took for both type of investor to break even is very different. So for the lump sum investor, the amount of time it took to break even on their S&P 500 investment is 74 months during the tech bubble that happened from the year 2000 to 2002. And 74 months is more than 6 years. Meanwhile, the amount of time it took to break even on their S&P 500 investment during the GFC, the Great Financial Crisis, is 53 months. So for the CSI 300 during the peak of the China market crash, it is 62 months. And finally, for the COVID crash, it's around 7 months. Whereas for investors who did RSP, the amount of time it took to break even was much faster. So during the tech bubble, it took them only 38 months, Great Financial Crisis, 25 months, China market crash, 18 months, and the COVID crash, it is just 5 months. I think it's pretty clear to say that RSP are very powerful in a bear market. They allow investors to purchase investment at attractive prices when most people are too afraid to buy. So some of you may be wondering, what do the pros of dollar cost averaging look like versus lump sum investing? So for dollar cost averaging, by definition, and as you will know by now, you are investing your cash in equal amounts over a period of time. For example, investing 120,000 in 10,000 monthly installment over 12 months. The pros is that in a way you are contributing to your portfolio in a series of small amounts, which is a good way to ease yourself into the market, particularly if you are cautious about the market outlook. And since investments are made over time at various prices per share, the approach actually reduces the sensitivity of your portfolio return to a single trade date, potentially making it easier for you to ride out the market's ups and downs. For example, if you invest the first of several installments right before share prices drop sharply, you will have incurred an unrealized loss only on the portion invested thus far, and not on the entire amount you intend to invest. So this approach may help you to commit to a strategy even if the initial returns are poor. So during periods of market volatility, it may also help you to feel less compelled to change or alter your underlying strategy for achieving your long-term goals. And on the other hand, for lump sum investing, so by definition and its name, lump sum investing actually means that you invest all at once. So the pros is that you get to deploy your capital right away. So we believe it is obvious that dollar cost averaging strategy employed by RSP actually outweighs the pros of lump sum investing. Now that we have gone through the benefits of RSP, let's move on to who should adopt RSP. So after knowing the benefits, it is no surprise that the RSP will be suitable for any investor seeking benefits like a potentially lower average cost, like a lower entry price, automatic investing over regular intervals, and reduced decision-making stress during market volatility or market uncertainty. It can also be particularly useful for beginners lacking experience in market timing and long-term investors committed to regular investing but are unable to closely monitor market conditions. Next, I also want to share how you can build your own investment portfolio from scratch using RSP. It's a very simple three-step process, which starts with asset allocation, then product selection, and finally a review and rebalancing of the portfolio. Okay, we will start off with the very first step, which is asset allocation. So in this example, we use the two most common sets of asset classes, which are equities and bonds. When it comes to building your portfolio, every investor needs and goals are different. Choose an asset allocation, which is how much weightage you want to allocate for equities and bonds that can fit your needs and goals. So a conservative investor tend to be more risk averse, so they can't afford to lose too much of their portfolio value. Hence, this type of investor would allocate more of their investments into bonds, as bonds are typically less volatile and can provide steady cash flow. On the other end of the spectrum would be an aggressive investor. Aggressive investors tend to have less risk aversion. They could be someone who is young and has a long investment horizon. So the type of investor tends to allocate the majority of their investment into stocks, which are more volatile but can potentially generate higher returns. And finally, if you are not comfortable with either of the extremes, you can actually consider a balanced portfolio where you get a decent amount of exposure to both stocks and bonds. So after deciding your asset allocation, the next step is actually product selection via ETFs. So this section will be shared by my colleague Chloe later, so I'll leave her to it. So moving on, after you have selected a suitable product and started investing, the last step is to review your portfolio. Note that when we say monitor and review your portfolio, we mean doing it on a quarterly or monthly basis and not on a daily basis. So you may wonder, how do we monitor and review our portfolio? So first, we can check to see if there's a need to adjust our portfolio and class weights to reflect market views. So if you see a higher potential in equity market, rather than fixed income, you can actually take this chance to increase your exposure to equities. Again, this depends on your risk tolerance, as mentioned earlier. And another thing to consider would be the investment products you have selected. For instance, if you realize a particular ETF has been underperforming and not delivering the expected returns, maybe it's time for you to switch to another better option. Last but not least, we can also check to see if there's a need to rebalance your portfolio, especially if the portfolio allocation have deviated substantially from the initial target. So for example, let's say you are a balanced investor, which means you should have 50-50 allocation to both fixed income and equity. But due to market volatility and uncertainty, now your allocation is perhaps maybe 35 to 65. So when this happens, you will probably need to make some adjustments towards through selling and buying of your respective investment products to bring it back to the neutral allocation of 50-50. Okay, I think it's better if I illustrate how you can make one with an example. So here I have a hypothetical portfolio of a moderately aggressive investor. So for a moderately aggressive investor, their asset allocation could be 70% in equity and 30% in bonds. The next step is product selection. Over here, I'm assuming that this investor wishes to invest globally. For example, I've chosen the Vanguard Total World Stock Index ETF for some global equity exposure, and the Nikko AM SGD Investment Grade Corporate Bond ETF for exposure to bonds. So based on this, assuming that the investor is willing to put aside 1,000 SGD every month, they should be putting 300 SGD into the bond ETF and SGD 700 into the Vanguard Total World Stock Index ETF. Okay, I hope you now have an idea of how you can construct a simple portfolio using ETF available for RSP. So moving on, I'm sure by now you have all heard of the new Bitcoin ETFs hitting the market. So I would like to take this time to share about this. So recently, 11 spot Bitcoin ETF were approved by the SEC to begin trading on stock exchanges. So in short, these 11 new spot Bitcoin ETF actually provide an avenue for investors to gain exposure to Bitcoin's price movement. And the new ETF actually have gathered many investors' attention, especially as Bitcoin is constantly in the news. We, however, think that investors should avoid this new ETF for the following reasons. So firstly, Bitcoin lacks fundamentals. So cryptos such as Bitcoin do not enjoy a stream of earnings like a company, nor does it offer coupon payments like a fixed income instrument. This makes it impossible to formulate a credible or reliable valuation framework, let alone derive an intrinsic value. So aside from the lack of cash flow and income, crypto does not have a proven long-term relationship with any economic fundamentals, unlike equities, fixed income, commodities, and even currencies. So to sum things up, with no fundamentals, it is impossible to determine its intrinsic value, and hence its price is also being fueled by sentiments, which makes it highly speculative and risky. Next, one often advocated use for crypto, especially Bitcoin, is its use as a form of money transfer or currency. So two aspects of Bitcoin actually makes it very unsuitable for such a purpose, namely its volatility and its transaction frequency. So firstly, Bitcoin volatility makes it unsuitable as a medium for transaction. And without this stability, prices of daily goods can become very erratic and incredibly volatile, which is less than ideal environment for everyday citizens. And there's a reason why price stability is often a target for central banks and governments, and Bitcoin as a currency fails to meet that simple requirement. And in addition, due to the energy and computing power required to process a transaction, Bitcoin can actually only process up to 7 transactions globally per second, and takes about 10 minutes for a transaction to be processed. So in comparison, a Visa payment takes seconds and can process up to 24,000 transactions per second. Therefore, due to scalability issues, the transaction rate for Bitcoin is certainly not going to be sufficient to be used as a global currency. Last but not least, it seems as though investors may have already forgotten that the crypto space is filled with scandal, as seen in the past few years. So from the downfall of the Terra Luna algorithmic stablecoin, which is in itself a Ponzi scheme, to the collapse of the Three Arrows Capital or FTX, which used investor assets to speculate in the markets, this incident actually served as huge warning signs that the crypto space is extremely dangerous. And beside these real-life examples, the crypto space continued to serve as a platform for many money and theft, as like hackers or criminals actually attempt to conceal their activity and feed these like illegal funds into the economy, banks, financial institutions, and lawful investment, among others. Until there is greater transparency and a proper regulatory framework, the crypto space actually remains a very dangerous space. Hence, for these highlighted reasons, we do not recommend investors to invest in Bitcoin ETF as part of their investment. And hence, we do not offer this ETF for RSP as well. So moving on to the last slide, just want to emphasize that while there are many ETF options out there for investors to consider, like the Bitcoin ETF as mentioned, not all actually are suitable options for dollar cost averaging or even for RSP. So to end off, this slide here actually summarizes what you need to know and understand about RSP. So why should investors invest in RSP? RSP are a disciplined and fast-free way for us to stay invested regardless of market conditions. It helps investors to avoid emotional investing, especially during a market downturn. And investors who wish to build a portfolio using RSP can consider the simple 3-step process as shared earlier. The first step is to decide your preferred asset allocation by understanding your risk tolerance. And the next step is to select the products that you believe is suitable for you, and also what kind of exposure you want, the type of ETF that you want. And the final step is to actually conduct a regular review and rebalance your portfolio, especially if your asset weights actually deviate substantially from the initial target portfolio. With that, that's all I have today. Thank you. If you have any question, please indicate in the Q&A as well. Thank you.
So sorry for some technical issues. So hi everyone. So thank you for joining us today. And my name is Chloe, and I'm a research analyst with the Research and Portfolio Management team at iFAST. So my colleague Charmaine has just shared about the concept of dollar cost averaging. And so when it comes to investing, especially given the difficulties and challenges of trying to actually time the market. And so now I actually would like to share about some ETFs to actually consider to actually choose in the first place. And so for this part of the presentation, I will actually be sharing this, and especially in the later part. So to put this in the visual form, so here's the outline for today's presentation. I'll just start off to give a brief overview with regards to the ETFs that you can actually go about to select for yourself. But last but not least, I'll actually be sharing some ETFs to consider, as well as our ETF focus list, which can guide you through your investment journey. So without much further ado, let's begin with a brief overview of what are ETFs. An ETF is essentially a basket of securities that actually track an underlying index, providing investors with access to a portfolio of stocks, bonds, and other asset classes such as commodities. And ETFs are passively managed, so they're able to actually produce a return that replicates an underlying index. However, there are also active ETFs out there which actually aim to outperform the benchmark. And the underlying index can be a market index like the STI or the S&P 500, or an index that actually tracks a specific sector, such as the financial sector, for instance. And there are various types of ETFs out there that can allow investors like you and me to actually reach every corner of the market. And the most common type of ETF would be the equity ETF, which allows you to actually track a particular equity market or specific industry. And there are also fixed income ETFs out there that can actually help to track a corporate bond market or government bond market. And besides ETFs, other ETFs out there can actually provide exposure to alternative assets such as your commodities or currencies. And given that there are so many ETFs from various exchanges, selecting the right ETF could actually be a daunting task. So not all ETFs are also made equal, and I would like to share with you a few factors to actually consider when selecting an ETF. This is essentially our ETF selection methodology. So when choosing an ETF, we look at both the quantitative factors and the qualitative factors. And I'll actually be going through the quantitative factors first. So under the quantitative factors, we actually consider these 3 factors as seen over here. So starting with the first factor is that of the expense ratio. And this is something to really consider when selecting an ETF. And expense ratio is expressed as a percentage of the ETF's average net assets. And this is the annual cost that investors have to pay in order to cover for the ETF's operating expenses and management fees. So in essence, assuming all else is equal, the lower the cost, the higher your net returns. And expense ratio is essentially very important. And I'll show this example within the next slide. So over here, I just have a simple example to illustrate how the expense ratio can actually affect your investment returns. So let's assume that you put an initial investment of an amount of $10,000 in an ETF over the period of 5 years. And if you look at this table over here, the ETF is able to actually generate an annual return of 10%. And if the ETF you invest in has an expense ratio of about 0.5%, your investment will be worth around $15,700. And this is after around more than $300 have been deducted off due to the expense ratio, and hence the impact of returns after 5 years will be around -2%. Secondly, a factor to actually consider is that of liquidity. And this actually refers to how easy it is to buy or sell an ETF quickly without affecting its price. And naturally, we prefer ETFs that are more liquid, which also means that they should have a higher average daily volume as well as a smaller bid-ask spread. So on the next slide, the last quantitative factor that we actually look at is the tracking difference. And this is essentially the difference between the ETF's performance and the performance of its underlying index, given that ETFs actually trade an underlying index. And there will always be a tracking difference, seeing that it arises due to many factors such as expense ratio, rebalancing costs, currency hedging costs, and securities lending costs, so on and so forth. And having this smaller tracking difference would mean that the ETF's performance is closer to the performance of the underlying index. And given that the primary objective of the ETF is to replicate the underlying index, a smaller tracking difference is actually very desirable. On the next slide, after considering all these quantitative factors, I think we'll move on to that of the qualitative factors. And these are things such as the choice of your index as well as the structure of the ETF. And this will also affect our decision when trying to select ETFs. So when choosing an ETF, it's actually important to consider the choice of index and see in the next slide. And so it's actually good to understand the index that the ETF is tracking. So the underlying index has to be a rather good representation of the market and the sector that the ETF intends to track, and such information can be found in the ETF website or the fact sheet. So let's say I'm interested in investing in the Japanese market and want a rather diversified exposure rather than a specific sector exposure, for instance. So when I'm looking for an ETF out there to actually consider, I would definitely look into the investment objective as well as the top holdings for a start. And all this would actually be useful as it will provide a good gauge of the ETF's underlying exposure. So the next and the final qualitative factor we actually look at is that of the structure of the ETF. So an ETF can either have a physical or a synthetic structure, but we note that a majority of ETFs out there are actually physical. And what this actually means is that they hold the actual underlying securities that make up the index that they are tracking. So if the ETF actually holds all the underlying securities in the index, we call this actually a full replication. Meanwhile, if the ETF only holds a sample of the index, we call this a partial replication. And partial replication is usually used when there are liquidity issues or when there are thousands of holdings in the index. And this actually makes full replication very difficult and costly. Next, this actually sums up the factors that we consider in our ETF selection methodology. So I'll just leave this here for a while. But in total, there are actually 5 factors which we definitely take into account when trying to go about selecting ETFs. So next, after sharing about our ETF selection methodology, I want to end this presentation with actually some ETF ideas to actually consider or ponder about. And I do hope that this section would help give everyone some ideas of the ETF to consider, especially if you're just starting out on this journey. So on the next slide, we see that AI has been a hot topic in the recent months, ever since the launch of ChatGPT in late 2022. So since then, there have been a lot of companies or startups trying to ride on this wave with numerous large language models being launched. However, we think that the beneficiaries of AI will ultimately be semiconductor companies and big tech companies, as they are the ones who will be powering this. So they have the largest data sets, capital, manpower, and expertise to bring greater advancements to this area of AI. So starting with the primary beneficiaries, which are the semiconductor chips and equipment, we see that popular or well-known names within this space, such as ASML, your TSMC, your NVIDIA, AMD, they're all the enablers of AI. And AI models are currently under active development, with even greater, trying to actually meet this even greater computational needs. And this has translated into exceptional demand for your processors and helping to push all these global semiconductor stocks higher. Not to mention, your government incentive and base effects will also contribute to sales growth globally. So there are initiatives being put in place, such as the US $280 billion CHIPS and Science Act. They have spurred your companies like your Micron, your Qualcomm, your Global Foundries, and TSMC to actually expand their manufacturing capacity. So our recommended ETF for this exposure to the rapidly growing semiconductor space is the VanEck Semiconductor ETF. Essentially, this ETF invests in a basket of 25 US listed semiconductor stocks, and it actually looks at the largest and most liquid companies in the industry. And your top 10 holdings contains many familiar names such as NVIDIA, TSMC, ASML, and more within the ETF. Next slide. Besides the semiconductors, the technology sector is also no doubt another beneficiary of the increasing adoption of AI. And AI would actually propel your big tech firms to greater heights, expanding their market shares and profits across domains like your search algorithms, your content generation, and even your product recommendations. And big tech giants, they're actually positioned at this forefront, and they're actually set to capitalize on the upcoming phase of exponential growth, given that they are actually the companies that are armed with substantial capital as well as wealth. And not only that, they actually have the top tier talent at their disposal as well. And besides the adoption of AI, we believe that all these big tech companies would actually remain very resilient in this higher for longer interest rate environment that we are currently in, as they have actually substantial cash reserves. So investors can actually consider the Invesco QQQ Trust, or Triple Q in short, and this would actually provide diversified exposure to the 100 largest non-financial innovative companies, and this includes your leaders in your software, your hardware, your e-commerce, and social media, so on and so forth. And the big tech companies within your QQQ ETF actually have a weightage of more than 30%. Another consideration would actually be the Invesco Nasdaq Internet ETF, or PNQI in short, and this would provide an ETF that has actually greater focus on the software aspects of the technology sector. And similar to QQQ, the big tech companies have a weightage of more than 30% within this ETF. On the next slide, another ETF we actually want to share about focuses on quality companies. So the answer that we have to this whole value or growth debate, which is often talked about in equity markets, is that of actually quality. And we like these high quality companies, as regardless of economic conditions, these companies will remain resilient due to their competitive advantages as well as their dominance. And we think that this is a prudent long-term investment strategy that would actually put you in a far better position than chasing your short-term market movements. And a diversified way to actually get exposure to high quality companies is via the JP Morgan US Quality Factor ETF. And this ETF actually employs a strategy where they target the highest quality businesses with high profit margins and low debt levels to actually invest into. Last but not least, our research team has also, in the next slide, has also identified certain Asian countries that we think have strong growth prospects, and we actually call them our new Asian tigers. So we think it's important to actually identify these new Asian tigers, especially given the evolving geopolitics in recent years, which have significantly altered the whole Asian investment landscape. As we all know, there are huge tensions between the US and China, and this presents challenges, but at the same time also opportunities for your different Asian countries. So for instance, previous Asian tigers such as Hong Kong and Taiwan, they face increasing geopolitical risks from an increasingly aggressive China. Hence, we think that if we look to other Asian countries that can benefit from the current geopolitical climate or have strong structural drivers behind them, it would actually make for a better investment case. So for example, when we look into Japan, we see that the country is actually undergoing an economic revival, and its equity market has remarked on a remarkable rally, awakening from its 33-year slumber. And Japan's economy is finally getting out of deflation. And not to mention, besides this, your corporate governance reforms on its equity markets, they're all serving as tailwinds. We also note that the country has launched many initiatives that aim to foster the growth of its semiconductor industry. Hence, we actually consider Japan to be one of our new Asian tiger. Meanwhile, South Korea and Singapore, they have managed to retain their status as Asian tigers, as we see that they're being supported by your favorable government policies, as well as a rebound in the semiconductor industry. For instance, South Korea is actually home to some of the biggest semiconductor companies in the world, such as your Samsung and SK-hynix, and they are amongst the top producers of your memory chips. And Singapore will also benefit from the semiconductor upcycle, as a significant portion of Singapore's economic growth actually stems from its exports, with a notable focus on electronics. Moreover, its stable political environment and status as a financial hub has attracted money inflows into the city. We recommend the following ETFs for investors who do want to actually seek exposure for our new Asian tigers. So the following 3 product recommendations are listed as follows in the slide. So next, besides some of the ETFs that we have actually mentioned here, we also have other ETFs that we want to highlight for certain categories in our ETF focus list. And we've actually used our selection methodology earlier that I mentioned to actually go about selecting these ETFs. So if you do want to actually view the full list of ETFs on our ETF focus list, please visit our FSMOne homepage, and then you can go to the ETFs or your research tab and actually click on the ETF focus list. On the next slide, after clicking the above, you actually end up on this page. And we also want to share that we actually refresh our ETF focus list annually to ensure that our recommendations, they remain current and relevant. And currently, there are around 50 ETFs on our ETF focus list across these 6 categories as seen over here. And it actually serves as a good starting point for investors who are seeking diversified exposure to ETFs at a low cost, as we try to zero in on the best-in-class ETFs within the certain categories. And besides these ETFs on our focus list, we also do have some other ETFs that one can RSP into on our platform. So in fact, we have more than 150 ETFs available for RSP, and they span across various countries, sectors, and exchanges. And you can actually start going about your whole RSP journey by investing just about $50 a month. So with this, I actually come to the end of the presentation, and I do hope that this session has been very enriching and useful with regards to how we go about selecting ETFs, as well as some possible ETFs for you to consider moving forward. And once again, I'd like to thank everyone for joining us tonight.